Hello, this is Sarah Kay, and welcome to this Croner eCPD module. Input tax incurred on certain high-value capital assets must be adjusted over a period of 5 or 10 years. This module will enable you to understand when the capital goods scheme applies and how the calculation should be undertaken. Normally, when a business incurs an expense, input tax recovery is determined when the expense is incurred, with an annual adjustment undertaken at year-end by partially exempt businesses. There are two cases where input tax recovery is not fixed in the year it is incurred. First, if there is a change of intention before the expense is used, and second, if the capital goods scheme applies. The capital goods scheme requires that initial input tax recovery is adjusted over the first 10 or 5 years of the asset's life. So, why is the capital goods scheme needed? To give an example of what HMRC is seeking to avoid, let us take a bank, which makes mainly exempt supplies and constructs an office building. It recovers all of the VAT incurred because initially it puts staff working on the taxable parts of the business in it. But after input tax has been recovered, it moves staff who work on the exempt side of the business into the building. The bank is thus using an asset on which input tax has been recovered for an exempt purpose. The capital goods scheme aims to avoid this by making our hypothetical bank adjust its input tax recovery over the first 10 years of the asset's life. The capital goods scheme does not apply to all assets. It only affects 3 classes of asset: land and buildings, computer equipment, and aircraft, ships, boats, or other vessels.
Please click on the buttons to find out more.
The CGS operates in the same way for all three asset categories, with one difference being that the adjustment period is about 10 years for land and buildings and about 5 years for computer equipment and aircraft, etc. As mentioned earlier, capital expenditure is defined according to normal accounting principles. HMRC would only change this policy if a business adopts unusual or non-commercial accounting practices, or they thought that there was some avoidance going on. Having identified assets subject to the scheme, we need to understand how the calculations are done. There are three main steps. Step 1 is to define the CGS interval. Although most people talk about the scheme in terms of years, intervals are not necessarily 12 months long. Interval 1 of the scheme starts when the asset is first used and ends at the end of the VAT year, i.e. the following 31st of March, 30th of April or 31st of May, depending on VAT stagger, or 31st of March if the business is on monthly returns. Succeeding intervals, in normal circumstances, end at the end of the following VAT year. Step 2 of 3 is to determine the baseline VAT recovery in interval 1. This is calculated according to normal VAT recovery principles. It is a common misconception that the scheme means that input tax recovery in interval 1 is subject to additional restrictions. It is not. All of the VAT incurred can be claimed as determined by the business's partial exemption position. Input tax on high-value capital items, particularly land and buildings, may be incurred over many years before first use. As we will see on the next slide, careful records must be kept to determine baseline VAT recovery. This slide shows how baseline VAT recovery may be calculated in practice. A partially exempt business constructs a building over the course of 2 years. Step 1 is to confirm interval 1. This starts on 1st of June 2018 when the building is first used and ends on 31st of March 2019, being the end of the VAT year for a business which submits quarterly returns. Input tax incurred was recovered at the time it was incurred, using the business's normal partial exemption recovery percentage. Thus, of the total £170,000 input tax bill, £47,500 has been claimed, so the baseline VAT recovery at the end of interval 1 was 28%. Having defined the interval and baseline VAT recovery, adjustment calculations must be done at the end of the following intervals of the scheme. These adjustments are determined according to changes in the partial exemption recovery rate for the asset. Total input tax is divided by the number of intervals, and then part of this fraction is repaid to or reclaimed from HMRC, depending whether taxable use has increased or decreased. The adjustment is included in the second return after year end. Let us return to our example from 2 slides ago. We had a partially exempt business whose baseline VAT recovery on a new building was 28% of the total £170,000 VAT bill. In interval 2, the recovery percentage fell to 24%, so an adjustment is needed. Total input tax divided by number of intervals is £170,000 divided by 10, and 4% of this, i.e. £680, is repayable to HMRC. The repayment is included on the September 2020 return, i.e. the second return after the 31st of March year end. If a CGS asset is sold before the scheme has expired, the scheme ends and a final adjustment. The adjustment assumes that for all remaining intervals the asset is used wholly for taxable or exempt purposes depending on the liability of the sale. This can catch businesses unawares. In our example, XYZ Limited is a fully taxable company which bought an office building for £400,000 plus VAT. Clearly, because it is fully taxable, the capital goods scheme has never been an issue. However, the building has been sold in a VAT-exempt sale before the expiry of the scheme. The sale of the building in March 2019, with 6 intervals to go, results in £48,000 being repaid to HMRC, because it is deemed to have wholly exempt use for those remaining intervals. If an asset is sold before the expiry of the CGS, as well as the final adjustment, the disposals test may apply. The disposals test is a piece of anti-avoidance legislation which aims to prevent the final adjustment being manipulated by a taxable sale at undervalue. The disposals test states that if total input tax recovered on the asset, i.e. baseline recovery plus all adjustments, exceeds the output tax due on disposal, the input tax recovery is capped. HMRC's policy is that the disposals test will only apply if an unfair tax advantage may result. It therefore seldom arises in practice when dealing with arm's-length commercial transactions, but it should be borne in mind when there is a connection of some kind between the parties to a sale. Lastly, we consider the loss, theft or destruction of a capital goods scheme asset. These events bring the CGS to an end, and although a final adjustment for the interval in which the loss, theft or destruction took place must be done, there is no requirement to undertake additional adjustments. In this final section, we will highlight some situations where the capital goods scheme needs special consideration. We do not have time to consider them here, but there are specific rules and anti-avoidance laws which should be taken account of when CGS assets are involved in land transactions and VAT groups. Such transactions should therefore be reviewed carefully. We will, however, briefly consider the capital goods scheme issues which arise when a business is sold as a going concern or where an owner registers or deregisters for VAT. First, transfers of going concerns. When a CGS asset is included as part of a TOGC, the new owner takes on the seller's CGS obligations. The scheme does not end, as it does in other circumstances when an asset is sold. If the purchaser does not take on the seller's VAT number, there are two consequences. For the seller, the current scheme interval will end, and an adjustment for a probably short interval needs to be done. For the purchaser, the next interval of the CGS starts on the day of the transfer and will end in 12 months' time, unless the purchaser obtains HMRC's agreement that intervals can be aligned with his normal VAT year end. If the seller's VAT number is transferred, then the scheme will continue as normal under the registration's new owner. Although uncommon, it is not unheard of for the owner of a CGS asset to register for VAT after it has been purchased. In this case, no pre-registration VAT can be recovered, so the baseline recovery is nil. To take account of the asset's use during the pre-registration period, one interval is deducted from the adjustment period for every 12-month period between the date of first use and date of registration. The CGS then proceeds. We will see how this operates in practice on the next slide. In this example, a fully taxable business submitting calendar quarterly VAT returns has registered for VAT on 1st of January 2011. At registration, it owns a building which cost it £250,000 plus VAT and came into use on 1st of October 2009. The CGS adjustment for interval 1, which ends on 31st of March 2011, is £5,000, i.e. a tenth of the £50,000 incurred. Because the pre-registration period contained one 12-month period, there are only 9 intervals remaining in the scheme. Thus, if the building is not sold, the owner will recover £45,000 of the £50,000 of VAT originally incurred. Lastly, we will consider deregistration. When a person deregisters for VAT, a deemed supply of assets on hand takes place. It is rare for the owners of CGS assets to deregister before they are sold, but if they do, a final input tax adjustment is needed as though that capital goods scheme item were sold. This final adjustment is needed even if no output VAT is due on deregistration, because the £6,000 threshold has not been passed. things to remember from this module are first, that the capital goods scheme is aimed at ensuring that input tax recovery on certain high-value assets is adjusted over time. The affected assets are land and buildings over £250,000 in value, computer equipment over £50,000 in value, and aircraft and ships, etc. over £50,000 in value. Baseline input tax recovery in Interval 1 must be recorded and then adjusted over the following 9 for land and buildings or 4 for other assets intervals. Finally, special considerations apply if a CGS asset is sold as part of a TOGC or if an owner of a CGS asset registers for VAT during the lifetime of the scheme. I trust you have found this module on the Capital Goods Scheme informative. Please exit this activity and click Launch Quiz to complete the quiz. Once you have completed the quiz, you will be able to print out your personal certificate. The module homepage also contains a link to the notes that accompany this module and to further resources available to you from Croner, including our in-depth and quick overview coverage. Goodbye, and thank you for using Croner eCPD.
For further information and to view the full range of Croner eCPD modules, visit our website at cronereye.co.uk.